An exchange-traded product is a type of security that is traded on stock exchanges, similar to stocks. ETPs are designed to track the performance of a specific index, commodity, currency, or other assets. They offer investors an easy and efficient way to gain exposure to a wide range of asset classes without the need to buy the underlying assets directly. Here are some key characteristics and types of ETPs. Key characteristics of ETPs. 1. Liquidity. ETPs can be bought and sold throughout the trading day on an exchange at market prices, providing high liquidity. 2. Transparency. Most ETPs disclose their holdings daily, allowing investors to see what assets the ETP holds. 3. Low cost. ETPs often have lower expense ratios compared to mutual funds because they typically have passive management, tracking an index rather than actively selecting securities. 4. Diversification. By investing in an ETP, investors can gain exposure to a broad range of assets or sectors, which can help diversify their portfolios. Types of exchange-traded products. 1. Exchange-traded funds. Description: ETFF are the most common type of ETP. They aim to replicate the performance of a specific index, such as the S&P 500, by holding the same or similar assets as the index. Example: SPDR S&P 500 ETF, which tracks the S&P 500 index. 2. Exchange-traded notes. Description: ETNs are unsecured debt securities issued by a financial institution. They track the performance of an index or benchmark but do not hold the underlying assets. ETNs are subject to the credit risk of the issuer. Example: iPath S&P 500 VIX Short-Term Futures ETN, which tracks the performance of the S&P 500 VIX Short-Term Futures Index. 3. Exchange-traded commodities. Description: ETCs provide exposure to commodity markets, such as gold, oil, or agricultural products. They can be structured as ETFs or ETNs and may hold physical commodities or use futures contracts. Example: SPDR Gold Shares, which holds physical gold bullion. 4. Leverage and inverse Ps. Description: leverage ETPs aim to provide a multiple of the daily performance of an index, such as 2x or 3x the return. Inverse ETPs seek to provide the opposite of the daily performance of an index. These products are typically used for short-term trading and hedging. Example: ProShares Ultra S&P 500, which seeks to provide twice the daily return of the S&P 500 index. Conclusion: exchange-traded products are versatile investment tools that offer investors a cost-effective and flexible way to gain exposure to various asset classes and markets. Understanding the different types of ETPs and their associated risks is essential for making informed investment decisions.